Tesco reported UK like-for-like sales growth of 1.8% for the quarter ended 30 May 2026, and the shares dipped. That reaction was predictable. The analyst response was not. Deutsche Bank raised its price target to 525p the same morning. Citi kept its target at 545p. Both houses called the miss an opportunity, not a warning. The question that matters is why two major brokers would raise targets on a number that fell 50 basis points short of consensus. Because that gap contains the read on what Tesco's business actually is right now. The provisional answer sits in the profit guidance. Tesco left its full-year operating profit forecast untouched at £3 billion to £3.3 billion, skewing toward the upper end. If the LfL Miss were a volume problem, profit guidance would have come down. It did not. That means the 50 basis point shortfall is being absorbed somewhere in the cost or mix structure. And that is what Deutsche Bank and Citi are pricing when they keep raising targets. What remains unresolved is whether that absorption holds as Iran war cost pressures build through the second half. Group sales came in at £16.82 billion, up 1% LfL overall, with UK food up 2.6%, fresh food up 3.6%, and Finest own label up 9%. Online sales rose 8.9%. The top-line numbers are not weak. The miss is entirely on the headline UK LfL figure. Fuel sales surged 19.5% to £1.74 billion, which inflates the revenue line but tells nothing about grocery health. Booker wholesale fell 3.2% LfL, worse than consensus of -2.4%, but slightly better than Citi's own -3.5% estimate. Every one of these numbers points toward a different conclusion for the share price, and that disagreement between named analysts on the same fact set is what creates the holder's dilemma.
The mechanism brokers are pricing is the mix shift running inside the missed headline. Tesco's Finest range, its highest margin own label tier, grew 9% in the quarter. Insurance policies grew 15%. Retail media, which carries near zero incremental cost, expanded. Mobile penetration rose. These are not volume lines, they are margin lines, and they sit entirely outside the LfL denominator that disappointed. Deutsche Bank described the quarter as noisy, that containing reassuring messages on profit and cash generation. That word, noisy, is the tell. The headline number is distorted, and the underlying margin mix is outperforming it. Citi named the specific mechanism that keeps its 545p target in place. Revenues came in line with its own model, even as LfL fell short of the street. That divergence, LfL below consensus, revenues in line, can only be reconciled if either volume elsewhere is compensating or average transaction value is higher than the traffic count implies. The Finest and fresh growth figures point to transaction value. Shoppers visiting Tesco slightly less often but spending more per visit on higher margin lines is a better business than high-frequency, low-margin traffic, and that is the read the brokers are making. The reversal the surface narrative misses is this. The consensus model assumed LfL strength would be needed to hit profit. Tesco has just shown that profit can deliver without it, because the mix is richer. That is a structural upgrade to the earnings model, not a warning. Holders who sold on the LfL print may have sold on the wrong variable. The check is whether this mix dynamic, high-margin own label, insurance, media, is a durable feature or a quarter-specific weather pull. The quarter ended in May included the UK's hottest May day on record, which the articles note drove 128% sun care sales and significant fresh food uplift. Some of that Finest outperformance may be seasonal.
The factor that could break the margin story is arriving from outside the store. UK food inflation stood at 3% in June, down from 3.8% in April, but the Iran war has been pushing up fertilizer, transport, and raw ingredient costs throughout the year. Tesco CEO Ken Murphy named the conflict directly in his Q1 statement as a source of ongoing uncertainty for many households. That phrase carries two risks embedded in one sentence. Households under pressure trade down, compressing mix, and input cost inflation, if it accelerates, erodes the margin line that absorbed the LfL miss. Tesco's current strategy, holding food inflation below the broader market to protect volume share, is precisely what allowed the Finest mix shift to work. If cost push from Iran forces a price response that exceeds the market, that positioning breaks. The articles note that Tesco holds 28. The genuine counter-evidence in the pool is Citi's expectation of a slightly negative share price reaction to the LfL miss. Citi sees the buy on weakness, but it has framed a near-term price dip as the entry point, not the current level. A holder acting on that read is waiting for the post-update reaction to complete before adding. The Citi and Deutsche reads do not actually disagree on the long-term thesis. They disagree on timing, which is what creates the paralysis at the current price. For the holder, the variable to track is not the next LfL print, but the half-year profit delivery in August. Tesco's guidance range of $3 billion to $3.3 billion skews toward the upper end, per management. If August H1 results land in the upper third of that range, the case is that the LfL miss was irrelevant noise. If profit comes in flat to the lower end, the LfL softness was a volume warning that showed up in earnings with a lag, and the broker upgrade thesis was premature. For the watchlist candidate, the 30 June Sainsbury's Q1 update is the trigger. A Sainsbury's LfL Miss matching or exceeding Tesco's shortfall validates the sector-wide consumer caution read and positions Tesco's profit guidance intact as a competitive advantage worth paying for. At 452p against a median broker target of 517p and Deutscher's 525p, the gap is 14 to 16%. That implied upside exists only if the mix thesis survives the Iran cost push and the peer comparison. The invalidating scenario is a Sainsbury's LfL beat paired with a Tesco cost inflation warning. That combination would reopen the question of whether the Q1 miss was execution, not noise. Neither holders nor watchers should act before 30 June. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.